Oh, I see. Okay, I was looking at it. I was just looking and comparing between the E-mini and I have here. So I have a few monitors, and so here I have on the other monitor I have the E-mini S&P. So I was just really just comparing between the two before class started to see if there was some type of divergence or something, and usually there's not. So if you take a look here at the E-mini S&P and the NQ, we see here that the market is going sideways. The E-mini is going up, the NQ is going up, so everything is really the same, right? So that's really why I have the NQ up. I was seeing if there was something different happening between the two, but it looks pretty much the same or equal. Okay, I'll switch over to the E-mini S&P as well. And if you're trading the E-mini, you should look at the MES, the micro. Okay, so when we're looking at here the market in general, I always say first, it's okay to trade right as the market opens, but it could be a little dangerous because of the volatility. So just as a rule of thumb, me personally, wait 10 minutes, 15 minutes just to let things calm down. And you can probably see that by when the market opens. You see that pre-market it's about 2 points, which I think is still healthy. For those of you who want to trade pre-market, you can see that as long as we're above 1 on the ATR and the average true range here, like this here, this is above 1, pre-market, it's fine. In the past, years gone by, the market was so slow that it was almost impossible to trade. If you remember, if you were in a trader back 5 years ago, 8 years ago, where the market was so slow, we really couldn't do anything with the average true range or the way these candles are working. But as long as it's above about 4 or 5 ticks, that's typically fine. We have some movement. So even if you want to trade pre-market, it's okay. Just make sure that we have enough activity worth our while. So you see where it drops here below about 1 or 1.5 here. This really becomes more of a chop and whipsaw. This is not what I recommend if you're looking to trade either pre-market or after hours. This is where it becomes difficult because the candles are so small. But we don't really have that issue. We have so much activity, we have so much movement, we have more volatility than we know what to do with, so that's not really an issue. Now when you look at here the ATR right as the market opens, it goes above 6, 7, 5. It's strong, so you have to be careful. In those things here, really focus on more of a smaller time frame if I need to. If you see that the market's too strong, let's say it's above 7 or 8 or 10, remember every trade that you take could potentially lose and make maybe 10 points. So that is a huge number. That's a lot of money that we're talking about. And the more risk you have, obviously, it impacts you psychologically as a trader. So if you see that as an issue and you still want to take trades, my recommendation would be to drop it down to a smaller time frame, and that would make the ATR and the risk smaller. Okay, so right now it's about 4.25. You can see that we don't really have any issues with the volatility. It's kind of moving okay. It's not that crazy, but if it was, then I recommend maybe going to a 20 or 30-second chart. So I have here a couple of defaulted settings here, so I'll just go to a 20-second chart, and you can see that the ATR now is 2.25. So these are just options that you have, which allows you to still trade, keep the risk in check, and you don't have to trade all these signals, obviously, right? It's not really the goal, but you can say after 3, 4, 5 signals, where am I at? What are we doing? Am I up for the day? Am I down for the day? And the risk is still relatively stable. Okay. Jay says here, there have been a couple of days in the last 10 that have been really spiky and I've been stopped out more than usual, but the ATR has been under 4. Is there something I should be looking for? Yes. So Jay, when you have a situation where you have maybe 2 losing trades in a row, right? So whether it be on the Sonic or something else, I would say stop, because the type of day that is actually being presented is a day where we have these big spikes and then the market doesn't follow through, or then it reverses. So if you have, or if you see before you even start trading, two losing trades in a row where that kind of situation is, it gives you a signal and then immediately it spikes down, and it gives you another signal and immediately spikes down. I would say to you to stop until things change, where you may see now two or three winning trades in the same direction. So you would see maybe two or three long trades or two or three short trades. And at that point, you can say, okay, things have changed or calmed down and I can get back in. In this kind of environment that we have with news events, something happens in a moment and then everybody reacts on it. Those type of situations are out of our control. So if you have a news day or a type of day where everybody's talking about whatever it could be, tariffs or political or whatever it is happens to be, and you see that kind of a situation, just pause and stop for a minute. News events, we know, right? So you have the news indicator, Jay, and everybody here should be looking at news. So if you have at 10 o'clock New York time, 8:30, sometimes at 12 or 12:30 the Fed talks, and at 2:30 we have the FOMC type of stuff. We know when those news events occur, we can back off a little bit. But when it's sort of like, you remember just the other day or last week when Trump, he did something like he decided not to install tariffs or extend them out, right? They talked about tariffs and then they changed it. And then when everybody caught wind of that, everybody reacted on that. So those are things that we really can't control, right? If we're in a trade and then everybody hears this news or it comes across the news wire and then, they decide to just go in at market, that's really out of our control. And that's why the stops are important. And then I would say, wait. Yeah, that was kind of a crazy day. And I think that was more in the afternoon. So I don't believe that I was involved in that type of a trade situation, because I believe that was towards the afternoon, if I remember correctly. Usually the morning up until 12, 1 o'clock, think of that as, the time where we are able to trade, we're able to do something with the opportunities. Like, look at this huge big spike candle right here, right? Now, I know the ATR is only about 2 points, but think of, the situation here where it goes up 3 or 4 points and then comes straight back down. This is just how the markets are playing out. Now, one thing I think is important, I'll just leave it here in this 20-second chart here just for a minute. Well, one thing I think is important is that when you do take a trade, and let's say that it hits your target, just as an example, it hits your target and it comes back down to where you entered. I avoid trying to take the same trade twice. Okay? So when you have this kind of a situation where you say, well, maybe I can, take the same trade twice, you see what happened. Taking the same trade twice would have stopped you out here. So I would avoid taking the same exact trade in this particular situation twice if it either got stopped out already or if it hit the target. Wait for the next one. We have a lot of opportunities. So just as an example. The other thing I talk about a lot is trying to get at a better price. So you see here where this is actually at a better price than where you would have entered had you just jumped in at market. Now, I know it's not always the case. Yeah, right. I say that a lot, Jay, because sometimes I look at the risk to reward. I say to myself, if the trade fails, am I able to maybe take a smaller loss? It doesn't always happen. Sometimes the market runs away. For example, I don't know if I can see here, like this example here, where it gave an entry and then immediately it just went straight up, right? Like right over here. So here's an example where there's nothing we can do about that. There's no better price, or you can't put a limit order at a few ticks better. Now, if that's the case, let it go, right? I don't want you to get a bad fill. I don't want you to chase it. And the same thing here, actually. This is maybe a better example right over here. You see how this triggered, and then it just went straight up. I don't want you to chase it. If you don't get it, you don't get it. We have plenty of opportunities. Wait for the next one. I think it's fine. So in this situation, it came down a little bit. I don't know how much it's going to go down, but I would say 2 ticks, 3 ticks. If you're able to see that in your favor, take it. And then as it starts to go up, you can actually have almost a setup where you say, well, I got in at a better price. I can even get out early. I don't have to hold for this particular target right here, right? I don't have to wait for that. I can get out sooner taking the same amount of ticks or profit because I got in at a better price. So even you can even consider it like that. And the other thing is, if you enter at a better price, the loss, if it goes against you and if it becomes a stop, is smaller. So for those reasons, when I look at a trade, I say to myself, oh, am I able to get it in at a better price? Now, this isn't really for everyone, and I don't expect it. It's not something I really push on everyone, but sometimes a lot of traders have told me that they enter right when the signal appears, and then if it goes down a little bit, they add a position, or they're averaging in and they add a second position. On the E-mini S&P, it's dangerous because of the volatility. You have a lot to lose. If you're using a micro, whether it be the micro NASDAQ or the micro E-mini, that may be an option because the micros are 1/10 the size, and that's not going to really kill you if those two positions get stopped out. It's not good to get stopped out, but it's a way to protect yourself. So as an example, let's say you entered here and then the market starts to go against you, and then you enter here. So now you have an average fill of somewhere in the middle. When it comes up, you have two positions. You can get out a little bit earlier or sooner, and you're protecting yourself. If you get stopped out, you do have to, and I really encourage you not to move your stop and to close the position wherever your stop happens. Want to learn more? Visit DayTradeToWin.com and get started with a free member account, which includes access to our trials, including the ABC software. Start learning the right way by using price action and avoid using conventional indicators. We offer unique strategies and proprietary software, including the Sonic system. Join Accelerated Mentorship and get instant access to all our software. Join our family of traders and let's get you set up in the next training.